Today, we're diving into the latest earnings report from VICI Properties, a real estate investment trust focused on casinos and entertainment properties. REITs, as a quick reminder, pool investors' capital to purchase income-generating real estate. VICI specifically targets properties that cater to the growing experiential entertainment market. Let's jump right in and see how VICI performed in the first quarter of 2024. VICI started the year strong, exceeding analysts' expectations for revenue. They brought in a total of $951.5 million, which is an impressive 8.4% increase year over year. This translates to a beat of $14.91 million compared to what analysts predicted. It's important to understand what analysts' expectations mean in this context. Financial analysts spend a lot of time researching companies and trying to predict their future performance. They release these predictions to inform investors, and exceeding these expectations can be a sign that the company is doing even better than anticipated. VICI also reported an adjusted FFO per share of $0.57. FFO, which stands for funds from operations, is a non-GAAP metric, which means it's not a standard accounting principle, but it's a common way for REITs to measure their core earnings power. It takes net income and adds back certain non-cash expenses like depreciation and amortization. So a steady FFO per share indicates consistent growth in VICI's core profitability. Perhaps the most significant takeaway is VICI's reaffirmed guidance for the full year of 2024. They remain confident in their ability to deliver within the range of $2.32 billion to $2.355 billion for adjusted FFO. On a per-share basis, this translates to an estimated range of $2.22 to $2.25. This reaffirmed guidance demonstrates VICI's management team's confidence in their business model and their ability to navigate the current market environment. It's worth noting that the economy can play a big role in a REIT's performance. Factors like interest rates, inflation, and economic growth can all have an impact. By reaffirming their guidance, VICI's management is essentially saying that they believe they can achieve their goals even in these conditions. Let's dissect the numbers a bit further to understand the drivers behind VICI's strong performance. It's important to note that VICI's operating expenses remained relatively flat compared to the first quarter of 2023. This demonstrates their ability to control costs while still generating healthy revenue growth and, of course, creates the spread that gives the company its profit. This cost control is crucial for maintaining profitability. Even with strong revenue growth, if expenses rise faster, it can eat into a company's bottom line. Another positive indicator for VICI's profitability is their adjusted EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. VICI's adjusted EBITDA increased from both the previous quarter and the year-ago period. This suggests that their core business is not only profitable, but also improving its cash flow generation capabilities. VICI's financial position appears strong. They successfully raised capital through debt and equity offerings, resulting in over $1.2 billion in cash and cash equivalents. Cash equivalents are short-term, highly liquid assets that can be easily converted to cash, so having a healthy amount of these ensures VICI has the resources readily available to cover their short-term obligations. Additionally, they have access to an undrawn revolver capacity of $2.3 billion. The undrawn revolver capacity is essentially a line of credit VICI can tap into if needed for future investments or acquisitions. This robust liquidity gives VICI the flexibility to pursue future growth opportunities, such as acquiring new properties or investing in existing ones. They can use their cash reserves or access additional capital through the credit line to finance these endeavors. The market reacted positively to VICI's earnings report, with the stock price experiencing a modest increase of 0.6% in after-hour trading. While not a dramatic jump, it suggests that investors remain confident in VICI's long-term prospects. Since the stock price reflects investor sentiment towards a company, a positive reaction, even if modest, indicates that investors believe VICI's performance is on track and their future outlook is promising. Here are some key takeaways for investors considering VICI Properties. Solid Q1 performance. VICI exceeded expectations for revenue and maintained steady growth in core earnings. Strong 2024 guidance. The company reaffirmed its full-year guidance, demonstrating confidence in its future performance. Focus on diversification. VICI is expanding its revenue streams beyond traditional ownership through lease financing and other solutions. Financial strength. The company boasts strong liquidity, allowing for future growth opportunities. Now, while VICI's performance is promising, there are still some factors to keep an eye on as an investor. First, impact of rising interest rates. Rising interest rates could make it more expensive for VICI to finance future acquisitions or investments. Higher interest rates typically mean VICI would have to pay more to borrow money, which could impact their profitability. Second, overall economic climate. A potential economic slowdown could impact consumer spending at casinos and entertainment venues, which could indirectly affect VICI's revenue. If people have less disposable income, they might be less likely to visit casinos or entertainment venues, which could translate into lower rental income for VICI from their properties, although I wouldn't worry so much about that, and you will see in a bit why when I explain what happened during the pandemic. However, there is some mixed data on this front, because I have also read research suggesting that when there is a recession, people start to gamble more, and bearing in mind that the main properties of VICI are casinos, this should be a boost for them. I personally like this REIT a lot, and even though it is fairly new, with only 6 years of history, I believe it went through the ultimate trial by fire during the COVID pandemic. During a once-in-a-lifetime event where the whole planet was locked down, a landowner of casinos, which were also obviously closed, managed to collect 100% of their rent. When I saw that, I was like, okay, you want to test a company? I don't think there is a better test than that. The reason behind this is that VICI owns iconic properties on the Las Vegas Strip, the main street of Las Vegas. People go there because of the name and brand of the casino and because of the iconic building. They don't care which the operator is and most likely don't have an idea. That means that any of VICI's properties operators basically would mortgage their kidneys before they allow themselves to not pay rent and get kicked out. This combined with leases that are decades long, sometimes up to 40 years, and contain inflation-linked escalators, make this REIT a true powerhouse, which is one of the reasons I like it so much. If you want to see more companies I like, go to the description and get my top 4 stocks and ETFs report for the current economic and geopolitical environment we are in. The report will be sent to your email address for free and will always be up to date. So, VICI Properties delivered a solid first quarter performance, exceeding expectations for revenue and maintaining a healthy financial position. Their reaffirmed guidance for 2024 reflects confidence in their business model. VICI offers a unique opportunity for investors seeking exposure to the growing experiential real estate market with a focus on casinos and entertainment venues. However, the potential impact of rising interest rates and economic downturns should be factored into your analysis. Let me know in the comments if you like VICI and if you invest in it. Also, check out this video that should have appeared on your screen already to continue with your investing education. Check important disclaimers in the description, and I'll see you in the next one.